Hello and good afternoon. I just hope that you can see me now in full screen here to today's Trading Spotlight webinar. Yeah, my name is Jens, by the way. I can move this here. So let me just check the box here, the chat box. Yeah, okay. So everything seems to be fine. Yeah, beautiful. So I want to welcome you to today's Trading Spotlight webinar and to a very fascinating topic today. In fact, one topic which covers the emotions in trading, a topic which is, yeah, part of our daily trading every day, in fact. And what we want to do today is we want to not just shine light on emotions in general and give especially a list of so-called cognitive biases here. Which naturally are part of us as human beings, but also we want to play a game, a little game which will perfectly illustrate what I'm talking about. So it's not just pure theory, but it's more like the game will show you loss aversion, a cognitive bias, which affects our capability, let's say. Yeah, probably that's a perfect way to put it, or explains why it's so difficult for us as retail traders to let winning trades run, to cut losing trades short, and via this game, you can perfectly see then why this is an issue. And this is, in fact, the first step to realize, okay, there are these cognitive biases. And then I want to show you a list which works perfectly fine, a daily routine, which all this will result in, then which will give you a better chance in the future to manage your emotions in your trading, in fact. And so this is now the perfect starting time to share my screen and have the first slide here. So in fact, we already went through the agenda. Let me just see it. So now everything should work. So we now went through the agenda here already with emotions in trading, the list of cognitive biases, in this case, in your trading, emotion-based retail trading results, in fact, we want to shine a light on, so real trading results, loss aversion, the game I promised, and then trading-related examples. So that's probably very interesting. Just let me give you some further details. When I held a presentation, that wasn't an English one, but it was one here in Germany. It was in Munich, in fact, several years ago. Then let me just, oh yeah, okay, perfect. Then a guy came to me after the presentation and said it was a really great a presentation on this topic, in fact, emotions in trading, cognitive biases and all this. And he was really excited. Still, he said, well, what he found a little difficult, or what he could imagine to be difficult, is that everyone really sees the parallels between the game we just played and trading in general. And this resulted in me adapting my presentation or updating my presentation for the next time, and give a real trading related example to just show you where this kind of emotions and loss aversion especially can be found, and where you can probably experience it yourself in your trading then. And yeah, at the end, the question how to reduce negative emotions in your trading, what can we do? And I will give you some techniques, a simple technique. In fact, it's just having a routine, having an agenda you go through every day. And this is exactly what we want to cover today. So first of all, this is me. I'm a little bolder right now. This is due to the lockdown here in Germany, and my kids. Yeah, my kids be the loveliest persons on earth. No, okay. So my name is Jens. So I'm located in Berlin, in Germany, and I'm in the financial industry for over 15 years now, close to 20 years. I started out as a bank clerk, or started out with a traineeship in banking, retail banking, in fact, and was quite clear right from the start that I wanted to be in the world of trading, in fact. So this world always fascinated me, fast-paced, adrenaline, to some extent testosterone. I mean, yeah, I think men are most likely to be found on a trading floor. unfortunately, we have to say, because there are certainly reasons why women are probably better traders. This is due to the to some extent risk aversion in some areas, in fact. And one of the reasons why rock traders in these contexts are most of the time men, I haven't even heard about the story around women, is most likely due to the fact that yeah, they can't really manage their emotions that well as women can in this context. So and this is not just to sound politically correct, but this is just a matter of fact. And but let's come back to me and my career and how I started my career in the world of trading. So I wanted to be a trader right from the start. I wanted to have something to do with trading, and I wasn't really willing to become free in my trading, let's say. I didn't want to go out myself, but it was more like I wanted to be a professional trader at a trading desk in an investment bank. And that was then the moment when I realized, okay, probably you have to learn something, study something first. It's not just a traineeship with a bank, but most likely you have to study something with a quantitative touch, let's call it. Mathematics, economics came to my mind. But still, I was already independent from my parents back then, had made some money during working as a trainee with the bank. And so I, beside my studies, wanted to work and wanted to somehow connect it with my goal overall to become a professional trader. And lucky me, I had a girlfriend back then. Her father knew someone working with a stockbroker, was a trader at a stockbroker. And so I got my first job as a trader, as a real professional trader, and learned really how to trade the markets from scratch. And this is, this is how I got started. And then everything else built on this then. And I never made it to Wall Street, but at least I made it to the world of trading. And I'm, to some extent today, I'm really happy that I found a way here to go out on myself, in fact, and become a trader, in fact. And I want to share some things here around my career and what I faced during my start to become a trader, respectively, even today, which faces me still, emotions and trading. And this is where we can close the cycle then. About Admiral Markets, probably very interesting. You have probably seen it in the top right corner, I think, is if I'm not mistaken. So that Admiral Markets is now Admirals. So there was a rebranding which took place. It's the 20th anniversary of Admiral Markets now this year. And so Admiral Markets is known to be a financial service provider now for 20 years in the market, especially with a focus on FX and CFD. But the rebranding takes place due to the fact that they want to expand their expertise to other fields of financial services, in fact. And so you can still find admiralmarkets.com in the web, but if you Google for Admirals or admirals.com, then you will also find Admiral Markets. So just that you probably are irritated a little. A fully regulated broker with global presence around the world. So that means especially important as me, as a former a bank clerk in this case, I know that it's so important to talk to someone in your native language. If you have an international client right in front of you and you're not speaking your native language, sometimes this is kind of a barrier, and it's difficult to build trust. In case of Admiral Markets, with again a global offices or offices around the globe, that way around, you have definitely a first choice beside the overall superior product range you can find there. True multi-asset broker, highly competitive when it comes to spreads. When it comes to the DAX, for example, here in Germany, we refer to Admiral Markets as the DAX expert. Tight spreads in the FX world, probably also one of the tightest offerings out there. And yeah, definitely worth a deeper look. And that's it around me. That's me. That's around Admiral Markets. And now we want to start with today's topic. So emotions in trading. And we want to, first of all, start with something we all know. We know that psychology in trading plays a crucial role. And in this context, the following four emotions are the most common ones. So first of all, there's anger and frustration. That's probably especially true, and it's no big coincidence in this context. Anger and frustration, they play a role, especially when it comes to losing trades. It comes also into play when we are talking about in this context about probably having taken a gain too early in this context. So this is definitely something to keep in mind, and where emotions arise from and could have a negative impact on your trading. Then fear. There's several ways of fear. So, for example, taking a trade and fearing that you're losing, that probably has especially something to do with trading too big, not really knowing what your edge is, and given the overall hit rate you can expect with your trading approach in this context, not really knowing what the payoff ratio, so the average gain to average losing trade is. So, not really knowing about the expectancy. If you have a positive expectancy, and given the overall trading stats then and the numbers based on, let's say, a backtest result or something, what's the current position size? You probably remember that a webinar several weeks ago, probably was the last one. I'm not really sure if I remembered right, but there we also mentioned the precision and the sizing in trading and how important it is, and introduced a criterion, the Cali criterion, the first step in this context, or first idea on how to calculate the right position size in your trading. But this is not just fear resulting out of taking a position and not really knowing if it's a winner or a losing trade, and uncertainty, which then spills over into fear, but also fear of missing out. So how many times probably you have seen sit in front of your screen and saw the market drop to the level which you wanted to enter the trade, and then you just saw that there was a pull back from there, but you weren't filled with your limit. So just to give you an example, right, from me and my recent experience I had in gold. So probably have seen that the low on Monday in gold was around 1,676, if I'm not mistaken. So quite yeah, a round number, let's say 676, and I had a limit at 675. So $1, and from there we saw a bounce of over $50. Then within 2 days or something. Right now we are going back to this level again. In fact, the limit, I still have it. It's still valid because it's a trade which I plan to open, and it's more kind of a long-term idea and playing a macroeconomic game here. But still, I was sitting in front of the screen and was just wondering, okay, what do I do if I'm not getting hit and not getting filled here on my limit? And then you feel this fear of missing out. I mean, I'm long enough in this industry. I'm trading for quite a while now, which makes it easier for me to induce rationality. This is a technique we could call in this context, and just say, okay, I wait, probably we'll see another test of this region, probably even a drop lower than that. Hopefully, yields keep on rising, and this increases the chance that I'm getting filled. But still, you're sitting in front of the screen, and if you do not have the experience and I'm trading the market for years now, you're probably you're fearful that you're probably missing out on a great trade, that the market really goes parabolic from there, and then you're entering the trade, let's say somewhere around 1,730 or something, 735 probably, so $50-$60 higher. I'm entering the trade, seeing the market move $5 in your direction, and now reversing and going back to 1,700, probably dropping even below that level. And this is also a fear which is quite common, causing emotions or resulting out of emotions, especially. So the fear of missing out in this context. Then we have also self-confidence, ego. So we're mainly talking about losing in trading, and this is probably the main focus. Also, many professional traders focus on. This is due to the fact that there's a common saying among traders where they say, well, you take care of your losing trades, and the winning trades will take care of themselves. This is true to some extent, but there will be periods once you get overconfident after winning streaks, for example. Just imagine you have 5-6 great trades in a row, and currently the market environment is perfect for that. Just look in the growth sector in the US, for example, tech stocks, Tesla, whatever. I mean, just imagine you bought Tesla somewhere around 1 year ago and just saw the market now ripping higher. Really, this was just like a vertical move higher. And you think you're the greatest trader on earth. You just invested 10,000 USD, and you probably made not just 100,000 out of that, but 150, 200,000 minimum, and made plenty of money, let's say. And why shouldn't you, once you now look at your account statement, don't think that you're a great trader? Well, because it was probably pure luck, because there was nothing really what you could do wrong here, but it was just like you go long and then hold the position. But nevertheless, we have a natural tendency to grow overly confident once we face such an environment, and we really think that we are the greatest traders on earth. And there's also something we call the Dunning-Kruger effect, something I will give you some details on in the next slide. But so self-confidence is a big problem, and once you feel, this is something I give you based on my experience as a hint for the future, if you feel overly confident in your trades, it's not that you should stop trading, because obviously you are on a not just heater, but obviously you have kind of a, let's call it edge in the current market environment, else you wouldn't make money. Still, it's probably a good idea to at least reduce the position size to some extent, to be prepared. There will be a time once your edge is probably not given anymore. Respectively, we'll see a natural pull back in your equity curve in this context. And so this is something where self-confidence, then classic emotion among humans, human beings in this context here, becomes a topic. And then there's also motivation actionism. So like you're sitting in front of the screen, waiting patiently and very disciplined for your trading signal. And yeah, the market just does not move as you need it to move to fulfill your plan and execute on your plan. So, and then you're sitting there and just thinking, in school, I had to learn. I had to, if I wanted to improve, I had to do something. In case of trading, natural tendency is like, well, I have to trade. If I want to make money, I have to trade, right? And then there's the motivation to do something. And then you execute because you say, okay, well, to some extent, the plan seems to be fulfilled. And this emotion then results in actionism and kind of, well, I have to do something, which is most likely the wrong way to do it. Because, for example, you're decreasing your overall risk reward, for example. Just imagine you have a buy limit, let's say at 1,675, as I had or have in gold. And then I'm entering the market $50 lower. I'm sorry, not lower, higher in this case. Well, that means to get a risk reward of 2-to-1 in this context, the market needs to rise another $100, which means that from the current market environment, you will have only a risk reward of 1-to-2 in this case. While if I entered $50 lower, I have a risk reward in case of a $50 stop, for example, of 1-to-3, which makes a big difference, especially if you trade this over and over again, and especially the shorter the time frame you trade gets then in this context. And this is something you have to remind yourself. And but we want to focus here today on something which, based on my personal experience, is the main emotion in trading you will face. And this is fear, in fact. So the fear of losing, fear of missing out, quite common. And based on this emotion, we get to see so-called cognitive biases. So, and what is a cognitive bias, or what are cognitive biases in this context? Well, this is systematically and flawed tendencies when it comes to percipience, remembering, thinking, and judging, which impacts your trading in a negative way. So this is how you would define that in a quite academic way. I give a shorter explanation for that. Just remember, even though Donald Trump is not the US president anymore, but just imagine 2016, that was a perfect example for that. In fact, it's the same year we had the Brexit, also true. So if you asked me before, and I'm giving webinars on a regular basis, which means also in German, I have recordings on that, and I can't say, well, I didn't see that coming, or it was like I expected it differently, or something like that. But there's a recording, and people know what I just said, and so there's no sense to me now to try to reinvent the past in this case or something. Well, if you ask me, let's say in May 2016, do you expect Donald Trump to be the next US president? Or do you expect the UK to vote for Brexit? In case of Brexit, we can also do this as an example. I said, well, I think it will be close, but I don't think that they will vote Brexit. And this is something which we finally got to see. If you ask me afterwards, so let's say in July, so you asked me initially in May, I'd say give it probably 20% chance that they will vote for Brexit. And then you ask me in July again, I'd say, yeah, certainly. I mean, probability was something like 50, 55, 60% probably that they vote for Brexit. And why? Well, certainly because look at all the developments in the European Union, for example, and everything's going wrong here. So you want to break out of this bureaucracy and want to leave all these problems this union brings with it. We want to leave it behind you. And so the people are probably tired or sick of that, of all the developments which took place over the last years. And so it's no big coincidence that they voted for Brexit. The interesting thing now is, if you ask me in May, 1 month before the Brexit vote, I was like a 20% chance that this would happen. Then in July, after the event took place, well, it was like 50, not 60 probably percent. And so what this means is something we refer to in trading, especially, like I knew that the market would go higher from here. So DAX moves higher is long, or I knew that Euro USD would drop here. Because the thing is, if you knew that, then usually it should be clear that there's no real rational reason not to be long then, if you're so certain. And the thing is, you're not certain. You say afterwards, this is what we call hindsight bias in this context. You say, well, you remember that as if you were so sure, but in the moment, once you had to decide whether to go long or not, well, you weren't so sure. And this is exactly where emotions and cognitive biases come into play and how you can imagine them, in fact. And so what I have here now is a list of cognitive biases, and we want to go through them in a quite quick manner, because this is a topic which we could cover easily 1 hour with. And the loss aversion cognitive bias, or the cognitive biases we refer to as loss aversion, is the one which our focus will be on here today, in fact. And so this is like this is the academic way to call it, loss aversion. It's what we refer to cut winning trades short and take what you have, but let losing trades run and hope that the market will probably turn around. And this is a natural cognitive biases, which results only out of the fact that we are human beings. And this is something we will shine a clearer and brighter light on in the following minutes then, in fact. But there are also other cognitive biases we've seen in trading, like the availability bias, for example. So the tendency to overestimate the likelihood of events with greater availability in memory in this context. So like the trade will be as explosive as the recent run higher in Bitcoin, for example. This is something you look at when looking at, for example, like the developments you've seen in Tesla, or when you look at the developments we currently expect probably in gold. You just remember what you've seen there, and given the overall the overall bias in the market and the given fundamental reasoning behind the trade, you expect a similar event to happen in gold when you're going along, for example, based on what you've just seen, based on availability in this case. In this context also, it goes to some extent hand in hand. There's also something we call confirmation bias. If I'm now going long, for example, in gold, or if I'm long in Tesla, in the stock, or if I'm long in Bitcoin, what I usually tend to do is I search for, respectively, interpret and focus on and remember information in a way which confirms my perception in this case. So if you, for example, are let's call it a Tesla bull, and you're long the stock of Tesla, well, you wouldn't refer to Tesla as a simple car maker. That's just not something you would do, because this alone would not justify the current market capitalization, respectively the valuation of the company. It just doesn't, given alone the aspect that there's limited capacity in terms of people who are demanding your product, or to scale your overall business in this case, and let's call this the gross margin in this context. It just does not justify such a valuation of the company. So you need to have a picture which is bigger than that. For example, see this as a provider of electricity, for example, put it that way. To be the company which is run by the greatest entrepreneur of our time, Elon Musk in this context. And once he finds a way to shoot a rocket to the Mars, Tesla will be the first car which is driven by little green men, for example, or something like that. So there needs to be more than that, and then just to say, well, it's just a car maker, which is probably, by the way, completely fine. I don't really think that this is a fair way to put it, but there are certainly people out there who doubt that the current valuation of the company is fine, or is fair in this context, and there's a serious reason to expect a further drop in the price of the stock price in this case. But still, once you're a Tesla bull, you will look for information which is in this context telling you, well, the company can grow even further because it's not just a car maker. And this is something which is also important once you enter a trade. So you are looking for research pieces which confirm your bias and which confirm your trade idea, which is completely normal. I can fully understand that, but this is something you have to keep in mind, because here then something comes into play where you have to understand that you could also be wrong. It's very difficult to accept this fact. And that's probably also one of the reasons why some people are still working without stops. We know how important it is to cut losing trades short, but you have to understand that there is a way to be wrong on the trade, at least for the time you plan to enter the trade. That could be true for my gold trade, for example, too. And this is something you have to keep in mind and remind to yourself. So again, induce rationality in this context. Then there's also something fascinating effect, in fact, the so-called Dunning-Kruger effect. And here I have a quick chart on that, how you can explain that or understand that. So the Dunning-Kruger effect is a cognitive bias you usually refer to a tendency, it is a tendency, it's explaining a tendency for unskilled individuals to overestimate their own ability here, and the tendency for experts then to underestimate their own ability. And trading is a perfect arena for this. How many people think, what can be so difficult to buy something at a low price and sell it at a higher price? This is no rocket science, no. The same is true for someone, and this is something I have to remind myself also when it comes to given an explanation on the current developments, for example, in the tech world. Where is this drop in the Nasdaq, for example, from mid of February, for example? How can this be explained? And then I start to talk about rotation from growth into value, and I start to talk about rising yields and real yields, and this is something I use to explain also the drop in gold and everything. And I just expect from someone listening to me that he understands what I'm talking about. The thing is that in this context, I have to remind myself that some people just don't understand that and see the world through a different lens in this context. But especially when it comes to trading, there's so many people out there just thinking, hey, why is someone who's a successful trader, why is someone then giving webinars for a broker, for example? Is he such a good trader? Or why does someone need to write a book, for example? Sometimes it's just because we want to share our knowledge. We want to exchange our ideas with other people. But this is something which, especially people who tend to be skeptical, which is to some extent understandable. Then on the other, because it's like, well, if I do not really know what I'm talking about, well, probably I should stay a little calmer then and listen to someone who wants to tell me something. Probably not just tell me something, but also teach me something about a topic I don't really know something about. And the Dunning-Kruger effect has this is a natural tendency. It's a cognitive bias, which is usually one of the reasons why many traders fail, because they think they are overly skilled. Again, it's not so difficult to buy low, sell high, but still, this is one of the key reasons to really overestimate your knowledge, respectively your skill level, why many traders fail, in fact. And why they probably also over leverage their positions, for example, don't expect a stop loss to be needed because, well, their opinion on the market is just right. And then so if I'm going long, the market just has to go up. And sometimes it works, but sometimes it doesn't. And if it doesn't and you're big enough, then, well, you probably could face some problems in your trading. And what we want to do is we want to here have a look at loss aversion in the real trading world. And what I have here is a graphic, which is from me. So it's the source is Jens. So this is my source. So what we're looking at here is results of a third-party broker in this context, and the time frame we are looking at here is, I think April 2014 till April or end of March in this case of 2015. So 12 months. And for example, in the case of Euro USD here, we are looking at over 9 million trades which were analyzed. And the blue column here is the average winning trade, and the red column is the average losing trade in this context. And what we can see is that it's around 20 pips here, in fact, the average winning trade, while the average losing trade is 40 pips. And what this chart does not include is the hit rate. The hit rate was in fact something around 60%, 61 if I'm not mistaken, while here the losing rate, or the loss rate in this case, was 39%. And then you could calculate that the average, or the average gain to average losing trade, but the expectancy of this currency pair here of the traders in over 9 million trades here, that the expectancy with this payout was minus 2.21 pips in this context. So on average per trade traded, you had a loss of minus 2.21 pips. Now we might say, okay, 2 pips, well, is this so much? Or it doesn't sound so big. Well, the thing is that if you're trading over leveraged, 2 pips, you lose every trade, could be enormous sum of money after a short period of time already. And what's even more interesting is that this is my personal chart. I also have seen a chart from Admiral Markets, and I used this in another presentation, was for Germany in this case. That was last year, somewhere in around November, December. I'm not really sure. And here the numbers were for the time span of 2019 December till December 20, or was it? Yeah, somewhere like it was 12 months. Probably was it even a little earlier. So something like August 2019 till August 2020. I don't really remember that well. But what I can say is, and this is a striking, was that the hit rate for retail traders. So we are looking at retail traders here, and at their hit rate respectively, at their payout profile, average winning trade to average losing trade. The interesting thing was that the hit rate was also around 60%. And that wasn't just focusing here on Euro USD in this case, but it was focusing on all traded assets in this context. So what does that mean? Well, that means that obviously retail traders have an edge. The edge seems to be that they are very, very good when it comes to analyze where is the market headed. Will it go higher? Will it go lower? A hit rate of 60% means 6 out of 10 times you're on the right side of the trade. Still, you can also see, and these are also numbers which you can see on websites, not just from Admiral Markets in this case, but every other broker out there. You have now, from a regulator, you have to show how many of your traders lose money right on the website. And you will see that over 70% still lose money with the trading. And what's the other word for this? While the hit rate is over 60%. And this is very, very interesting. And it comes down to loss aversion. So the average winning trade is smaller than the average losing trade. And now to illustrate you that this is not just a theoretical example here, and I just could say, no, you know what? What we want to do here in this context is like, I will leave it with that. Just keep that in mind. We will skip the next slide, and then I'll give you an idea on how to use that. I want to make you feel, or I want to give you an example which gives you a good explanation and a feeling which connects far better with this cognitive bias in this context. And therefore, what I have here, this is a little unfortunate, but okay, however. So we played 2 games, and they are independently from each other, and we played only 2 times. The first time, what we do here is we wanna choose between 2 options. Option A is you get right here and now 900 euros from me. So as a present, there you go, 900, and we're fine. You go home, and I will, probably, let me just have a look here at the number of attendees. I'll go broke with that. Okay, but this is option A. Option B is probably a little better, for me at least. You have a chance of getting 1,000 euros in 90% of the cases, but in 10% of the cases, you will get nothing. And it is as if we have not played the game at all, and you get nothing. I don't have to pay you anything, and that's it. So now the question is, game one, which option do you choose? And I'd appreciate if you just type in a quick A or B into the chat box, and I just give here in this context an idea. I will present you why this is of interest here. So by the way, we can now see, okay, this is beautiful. Thank you so much for all the answers here. So if I now have to give a rough calculation, I'd say there's a slight tendency for A, something like 60% probably. I have to count it, which is very, very interesting. So we just leave it here at this, okay? I give a quick, how can I say, a quick summary in a few seconds here. By the way, what just happened with 60 to 70% people saying we choose option A is something I have expected. And I will explain to you why I expected that in a few seconds. First of all, we want to play, before we do that, we want to play game two. We have option A. And in this case, I'll go home again with so many attendees here as a richer guy in this case, probably. And my wife will be very, very happy, especially right in front of the weekend. So you lose right here and now 900 euros. So every one of you playing the game with me has to give me 900 euros in this case. While we have another option in this case, you can also choose option B, which is you have a 90% chance of losing 1,000 euros, but also a 10% chance of not losing anything at all. So also here the question, which option do you choose? You take A or B in this context. Okay, this is very interesting. It's very interesting what's currently happening here in the chat box, because now there's a clear tendency. So it's not as clear as in one, in the first game. This is not an option. Delio says he doesn't want to participate. It's interesting. So in the first game, there was some more balanced. There was a slight tendency to A, but in this case, we have a clear tendency to B in this context. So many just typed in B in this context. This is no surprise. Let's shorten things up here. This is no surprise. I also expected this answer to be the main answer. And it's always the same, by the way. And what's very interesting, that is very, very important to note here. This is it's a simple game. It's a very simple game. And there's no right or wrong with each of these games. You can calculate it yourself. So I'm really playing a game, which is where the answer you give here is in fact a purely emotional one. Why do I say that? Well, because the expectancy of game A, for example, is 900 euros. You get 900 or you get nothing. Well, you get 900, that's it. So if you choose A, you just get 900, that's it. You can't lose anything. Option B is you have a 90% to get 1,000. So 90% multiplied with 1,000 is 900. And then you subtract 10%, which you multiply with 0. You don't get anything at all, which is also 900. So mathematically, the two options are the same. They're equal. The same is true here for this one, only with a minus in front of that. So the force sign here is a minus, and that's it. So you can see there's no right or wrong in this context. But the emotional answer in this context is, and you can check the chat box yourself, you can see that there's a tendency in game A for option A. You are risk averse, we would call this, when it comes to winning. So you don't want to gamble here and want to gamble for another 100 euros to just risk to not lose anything at all. While when it comes to losing, and this is here, the second game, then you say, well, if I'm losing 900 or if I'm losing 1,000, that doesn't really matter because it's just 100 euros more. But in case of 10% here, I have a chance in option B, I have a chance of not losing anything at all. And then just wait a second, just try to realize that. I think this is once the moment when the light bulb just goes on and just saying, yeah, that's right. Exactly. And this is the very interesting thing about this. This is what makes the difference between a professional, profitable trader and between a classic retail trader. And it's just human. We are not gambling when it comes to winning, which is crucial to the overall long-term success. Gambling in this context is nothing negative, but it's the same expectancy. But here you want to get more because the expectancy is on your side. You have a 90% chance of winning. So you just take the risk that you're probably losing in 10% of the cases, but in the long run, you will come out ahead. Well, when it comes to losing, there's no question about taking the loss right away. You just cut the losing trade short. 900 euros, you're done. You're not saying, okay, take out the stop and I just hope that the market will turn around. And if I lose, okay, I lose another 100 euros. But this is where the overall long-term negative result in your equity curve will naturally result from. And it's a natural tendency. And again, it's not because of not knowing what's going on in the market. The hit rate, long run hit rate from retail investors, and there's plenty of data which confirms that, is that many retail traders can perfectly analyze the market and trade with an edge in terms of telling whether the next move will be up or down. And the beautiful thing is we're small enough to position ourselves very flexible and go long or short at any time, at any given time. We're not a billion-dollar hedge fund who needs to scale into a position or something like that, but we just can enter with our 2-3 mini lots in this context in Euro USD or 1-2-3 DAX CFD, for example, no problem. And this is the big difference here. And so it comes really down to not letting or not being able to let winning trades run and losing trades short. I think this is very fascinating. Still, what I want to give you an example, and this is where the trading example comes into play then, which I mentioned at the beginning. So loss aversion is something you can also feel when it comes to following a trend, for example. And we go very simple through this. So you have a sequence of higher highs and higher lows. And you probably followed the daily webinars or Zoom meetings / streams on YouTube from my colleague Marcus. And he's also a trend follower in this context, and he makes this a topic. And the thing is, what we want to now do is we want to shine a light on the psychological side on this. Probably he has done that already, but let me just explain you where this game comes into play here and where it's trading related. So we have a sequence of higher highs and higher lows in this context. And now just assume that you're trading the breakout to new highs in this context. And then you have the risk in this context here. You place your daily stop or your stop loss in this case below the last relative low once the breakout occurs and the market moves in your direction. And you're probably happy. That's nice. I mean, everyone wants to see the market breaking out and moving directly in our direction, which is really, really nice. But then something happens, which is natural when it comes to trend following, right? The market has to see a pull in case of a long trade, respectively, a retracement in terms of a short trade. So there will be a natural tendency because now the market has the chance to form a higher low in this context and continue with its sequence and ride a next high in this context. So we have higher highs and higher lows. The only problem is once you enter the trade here and see the market move in your direction, you're probably happy to some extent, but try to remember how you felt once the market pulled in, what this causes you to feel and the pain you face, because you see now the market going into corrective move and something which is completely natural and it's a must because you have to see the market here in this context pulling in, because if it doesn't pull in, well, this is a problem, because then you don't have a chance to see here a higher low in this context. And so what's now interesting is that once you see the market moving 50% of your former gain here against you, this is the moment once you realize that it feels like this is the same level of pain if you look at the joy you felt here, once you drop even further and you're now seeing a plus minus zero in your account in this case, so you just gave back all your gains which you initially saw here in this context, that feels like a loss. And this is exactly where this loss aversion, the idea behind loss aversion, comes into play. Joy, when it comes to winning trades, is probably great, but the pain is twice as high if you see a trade moving against you, even if it's a break-even trade in this context. Just imagine you're taking out here in this context a trade there. It's a small gain. If you're stopped up break-even, it's nothing happened to your account. If you have a break-even +1, you have also the commission already. So it's like the account didn't move, but you feel like you just lost on the trade, which you didn't. And this is exactly where cognitive biases and emotions come into play, and why it's so difficult for us to realize a loss in this context. It's so difficult because the pain is so big, so great, that we just don't want to take the loss. And in addition to that, it's like then the next emotion comes into play, like greed and not being capable of the fear of missing out more. Is there probably more meat on the bone in this context once the market moves in our direction if you don't have a plan? But in this case, we want to mainly focus in this context here on the losing side. And so this is loss aversion and a trading related example. And now the question is, what can you take from this webinar for your trading? And the question you might now have is, what can I do to in this context, reduce these emotions, negative emotions in my trading? And there's a way to do that, a known concept, in fact. You need a daily routine. This is where it all comes down to. So you have to have not just a daily routine, but also then this routine should include like having clear plan you follow, a plan with an edge in this context. And this is something which you follow then every day, and which makes then concepts like the so-called crawler concept, or also what I also refer to inducing rationality, for example, easier. And delivers a short-term solution, at least, for mental instabilities which you will face naturally in your trading. And what you start with is the preparation. So the preparation in my case, for example, is that even if I'm now here in the webinar, I know once I exit this webinar, I close it, I will then switch over to the US markets and equity trading in this context. And I have already a game plan prepared. And I really know that I'm currently not focused on the market opening, but this is not a big deal because I've already a plan in mind to overcome this fact. Yeah, let's call it a fact. So I'm not focusing on the opening drive right now, so the first 10, 15 minutes of trading, but I will focus on the second day of the half, let's say. And this is something which my preparation already includes. And this means nothing more than I'm starting optimal prepared here and focused. Even if I'm right now here in this webinar, I know where to start and where I am if I exit this webinar and focus on the market opening then. And in this context, then the next thing is I trade the plan. That's what I do. I formulate a plan. Okay, I game the trade if you want, and then I trade the game. Or I think this makes perfect sense. You know what I'm talking about. And you don't do that and only that. So you make sure that you don't make any judgments or similar. And this makes it more likely to step into one of the described trading hazards, so-called cognitive biases. So what I'm talking about is only trading means really only trading. If you have a losing trade, which happens, it shouldn't affect your overall. I mean, it's nothing nice. Okay, so it shouldn't really be considered nice to lose money. Not that you misunderstand what I'm talking about, but you should not judge whether that was a good or bad trade. But in this case, you just should focus on the trading itself. Because if you judge the trade, the risk is that you get emotional. Once you get emotional, cognitive biases become a problem. And this is something you should always keep in mind in this context. So in the second step, after the preparation, second step is you trade, and that's it. And then you write down the result. So your trading result, your feelings, your emotions, unusual occurrences, for example, news which hit the wire and all that. And you write it down in your trading journal. And this is, in fact, purely quantitative, in fact. So the qualitative steps will take place at a later stage. So in fact, in the fourth I'm sorry, the fourth step here, you evaluate. So what you do is you ask, for example, did the trade take place in accordance with your trading approach? So did you follow your rules you set yourself? And was it technically correctly? Was it technically good what you did? Was the win-loss in accordance with your calculation, or did you face slippage, for example? So in case of being stopped out and working with a stop order, there's the problem that you're probably not getting the price you wished to get, for example. Or once you enter the market, did you get the price you wanted to get? Was the trade influenced by news, for example? Any central banker said something, that's why you woke up on the right side of variance. The market popped in your direction. And probably this pop had nothing to do with your overall expectations, so that it's probably an earnings play or something like that, where there's a fund inflows, let's say, where hedge fund says, well, the news were so good and the earnings of this and that company were so good that we have to put in our money here into that game, into the stock in this context. Also in this context, did you achieve your self-set goals? And once you did this, you step back and you just relax, to have some time with your children, play with them, or do some homework, work out, whatever. And you try just to bring some distance, let's say, here between you and the trading. And then you sit down again at your desk, and then you answer questions like, what new insights do I take into my next trading session based on what just happened? And write it down, very detailed. And this is like, for example, you want to improve your preparation, your warm-up, your daily warm-up you go through, and then you start over again the next day. And this way, you might probably say, okay, I need to do this every day. Yes. And sometimes it might feel like it doesn't make a big difference, but it's the small steps which will naturally result in a huge improvement over time. This is like, the small step approach, or I think there was a great book from James Clear. I'm sorry, I don't remember the name. 1% increments or something like that. So James Clear is the author. Just Google, or in this case, go to Amazon, James Clear. This is a good Atomic Habits. I'm sorry, that was Atomic Habits. I'm sorry, that was just the word I was missing. So Atomic Habits, this is a book which perfectly explains what this process works on. And once you start to work through this process, you start to go back from result driven and this natural tendency in this context, which will result in emotions, you will go over to process oriented in your trading, which will make it easier to cope with emotions and continue to improve over the long run. And then you will see a natural positive effect on your trading. And so that brings us to our summary in this context. So we know that, by the way, let me just check out here. Oh yeah, I'm sorry. Yes, sure. I mean, 1 second. So it's James Clear, and the book is Atomic Habits. We will also probably post a link to the book in the description box. Probably that's of help for you on the recording on YouTube. By the way, if you watch this on YouTube, if you just like what you saw, leave a thumb up here, or subscribe to the YouTube channel. Set a reminder for the next webinar, which will, by the way, take place with my colleague Paul. Is it Paul or is it me? So it's definitely next week on Wednesday. I'm not really sure. I think it's Paul who's the next. By the way, I think this book was also translated into Spanish, by the way. And there's also an audiobook. It's a fantastic book, just to say that. And I could easily turn around and show you that right now in the camera. It was one of the books I read. And Atomic Habits is also a book I know, which was published in Spanish. This is definitely something I know. Okay, so back to the summary. So psychology in trading plays a crucial role. Anger, frustration, fear, daily neighbors, let's say, in our trading. And based on my personal experience, fear is one of the main emotions in trading. Based on emotions, we get to see so-called cognitive biases. So loss aversion, availability bias, for example, confirmation bias, Dunning-Kruger effect, and so on and so forth. And to reduce this impact in your trading, you need a daily routine, a clear plan, which you follow every day and which is process oriented. So which shines the light on the process itself and is not so results focused in this case. So like, how much money did I make today, which naturally results in emotions. And the 5 steps you go through is the preparation, daily preparation, then the trading itself, and only trading without judging your results and hoping, or not hoping, but making sure that emotions does not interfere or interrupt your overall performance. You look at the result, you write down, you evaluate the result, and then you do the analysis. So this is like the, let's say, tweak and review part, let's say, which helps you to improve, and then or review and tweak, that way around. So you review the trade, and then you will formulate an idea on how to improve for the next time. And so in fact, that's it on today. For further information, please check out admiralmarkets.com. Check out the website for the upcoming webinar on Wednesday with Paul. Thank you. And so here is the risk disclaimer. That's it from my end. I wish you all the best. Happy trading. Watch your stops. Talk to you again next week on Friday. I definitely look forward to it. See you there. Happy trading.